CPI drops. Is inflation really cooling? What's going on, guys? Welcome to the Real Vision Daily Briefing. It's Wednesday, July 12, 2023. I'm Ash Bennington. I'm joined today by Mish Schneider, Chief Strategist at MarketGauge.com. Mish, welcome.
Thank you, Ash. Good to see you.
It's always good to see you. Always a pleasure to be with you on this show. Just a reminder that today is an extended version of the Daily Briefing. The second half of this show is available exclusively for Real Vision members. But the good news is you can sign up for free at the link in the description or scan the QR code on the screen. By the way, I should say, top of the show, we have a special message from Raoul Pal, our CEO and co-founder, of course. At the end of today's show, you will not want to miss that. So please stay tuned. Mish, obviously CPI day today. Tell us what you think big picture is happening right now.
Well, the CPI numbers, of course, are looking back, not necessarily forward. So that's something that we always have to keep in mind. Therefore, looking back, it wasn't a big surprise to see that it was softer than expected because one of the largest declines was in actually the energy space, which peaked out in June 2022, right? So if you just look at the year over year, that definitely has gone way lower. The question is, though, since those CPIs were produced and released today, what's happening in the energy market going forward? And that's certainly something we can talk about. In terms of the other areas, I thought there were a couple of surprises. I was surprised month over month to see the drop in airline fares. I rushed to book a bunch of trips thinking that fares might actually go higher. So I'm like, darn, timing wasn't great. But also there was some other areas that I thought were interesting, and no surprise, used cars going down. Was pretty obvious to me. Rents were slightly lower. So, these were the kinds of areas and some of it in the services that were gaining, like in hospitals and new vehicles, clothes, and of course food, which that's always going to be my major concern right now because of everything going on. So I guess the lesson to be taken from CPI was that it was a great trade into it to anticipate this. And now the question is going to be, can it sustain from here? And that, of course, remains to be seen.
Yeah, very well said, Mish, and a great overview. I want you to take a look at this chart. This is U.S. Consumer Price Index. This is looking at all items versus all items less food and energy, sometimes called headline versus core. What you can see there is that the headline number spikes much more dramatically, then drops much more quickly. What we see here is interesting. The number that's being cited today around the cable news networks, of course, is the 3% headline number. But if you look, ex-food and energy, also called core inflation, still more than double the target that the Fed is aiming at, 4.8%, 3%, of course, on all items. For those of you who are listening and can't see this chart, it's a good one. Mish, how do you think about all this? You mentioned the energy markets. I know there are a lot of things going on in this report, a lot of different numbers. We all look at different things. Talk a little bit about the energy markets particularly and the other internal dynamics that you saw in this report.
Well, what's so interesting is that in this report, of course, again, going back year over year, core versus headline, none of the inflation that we had coming into June, of course, was related on the backs of what happened with COVID and just a return to normalization as far as the supply chain and particularly inventory that had to rebuild. So I'm not necessarily convinced that the headline is one that should give people too much complacency. And I'd say the core is probably more accurate. And I actually brought in a chart, Ash, based on some projections that this whole CPI number is really basically getting ready to bottom, if not the June number, then the June going into July number, with projections, as you can see, of what are going to happen into 2024. And if you look at this chart, you can see that all of the projections are for higher consumer prices going into 2024. And I would probably, if I had to venture a guess, be in that camp. I anticipate that round two, and I know I've been saying this for a while, but round two is coming. And to answer your question on energy, I think part of the reason is what we're seeing in the oil market right now.
Right.
Yeah, so we have to look there. Now, right now, we basically rallied to $75, $76 a barrel. That's key resistance. But why did we rally? Well, number one is we still obviously have issues geopolitically. And in fact, I was listening to Jeffrey Sachs And he was saying he thinks the biggest obstacle that companies' bottom line will have going forward will continue to be geopolitics. And he mentions specifically Russia and China. And so that's one factor. We also had Russia cut production along with the Saudis, along with OPEC Plus, which comes to the tune of about 5% of the global demand. But I think even more concerning is our own strategic reserves, which are really at lows, which means if the market in the oil continues to go higher, we don't have that much to release. And probably a major policy error did not buy back when we had the chance enough. Right. At around that $67 a barrel. So demand is increasing where everybody was assuming it was going to actually fall. And I never really understood that, especially as we're going into summer months.
Yeah, right now on my screen, CL1 New York Merc Oil WTI August 2023 contracts. It's almost $76, $75.95 right now on my screen, up about 1.5% on the day, talking to precisely that point. Mish, one of the things I always enjoy about our conversations is that you're so good at zooming the camera out and talking about the big picture. I want to talk a little bit about the big picture. These are numbers that people who watch the Real Vision Daily Briefings I host know that I hit all the time, which is the extraordinary performance of U.S. equities year to date. S&P 500 right now up about 16.5% on the year, but that's the least of it. NASDAQ Composite up basically 33% year to date. NASDAQ 100 up, call it 40% year to date. Red hot U.S. equities market. One of the reasons we care about inflation, other than the pain that it provides for wage earners, is what it means, what it portends about what the Fed may or may not do next. Talk a little bit about that. Give a little bit of context on how you think about the big picture, particularly in relationship to inflation, the Fed, and U.S. equity markets.
Well, coming for the first 6 months to this point, again, was anticipated because of a few factors. One is that the sentiment around the country in particular was that the economy had contracted enough and definitely was ripe for growing. And one of the reasons for that was because it also seemed apparent that the Fed, at the very least, was going to slow down how fast and how many times they were going to raise rates, and they did that. So that was the second anticipation, that we would get to some ceiling in terms of the interest rates and the Fed funds rates. And certainly in looking at the mortgage rates, we're a little over 7%, maybe coming back down today. But nonetheless, 5 to 7% seems normal for interest rates for mortgages. And then, of course, the Fed fund rates at around 5.25 seem relatively normal. People didn't think it was going to go much higher. Thirdly, even though tech typically does not rally in the face of high interest rates, it was so undervalued coming into this year that looking at the fact that the Fed was probably not going to go much higher, at least not for the first 6 months, of course, fueled the incredible tech rally that we saw. And AI, of course, as we know, also became the big buzzword. And so all of this has really helped, along with the fact that we still have a relatively strong housing market, considering how many people were calling for a real estate crash. Not me. We also have a very strong labor market, maybe a little bit of signs that things could deteriorate a little bit in spite of the interest rate raises. So it seemed like the U.S. was going to get the pass on recession, number one, again, in the face of even the inverted yield curve. And number two, possibly the soft landing. And that was all the optimism, and energy prices going down up until this point. All of this was the optimism coming to this point. What's so interesting about July is, well, one of the indicators that we use at Market Gauge is our 6-month calendar range reset. So it resets in January. And in January, if you look back, NASDAQ took out that 6-month calendar range high, and basically even March, with a slight correction from the banks, took off. Now, as we're getting another reset, it'll happen next week, right into earnings season. I think it's going to be very interesting to see if, A, all the reasons that we felt cheerful coming into this point continue to be cheerful, number one. And number two is, what do the technical indicators say about the next 6 months vis-a-vis the 6-month calendar range, which isn't 100%, of course, Ash. But it's very statistically important Because if we see the NASDAQ, even if NASDAQ continues to go up from here, if next week when it resets, it doesn't take out that high and starts to come off a little bit, we haven't had that big a range since July has started. So anything can happen, and that's what I'm saying. That's the first part of that. And looking at NASDAQ, we'll talk about small caps after. Talking about the Fed, it seems to me that, first of all, the inverted yield curve, but the back end, the long bonds are saying a different story. So people have said, people way smarter than me in terms of economics, have said that yield curve inverted to this point, which is historical, going back to 1983, generally points to a recession, but not necessarily right away. So are we 5 months away, 6 months away, a year away? Of course, we don't know that.
Right.
But what is interesting is that at least for us lay people, we can look at some of the relationships that we love to look at. Besides the 6-month calendar range, we can look at the long bonds right now and ask, have they bottomed? And if they have bottomed, what does that mean? Are they going to outperform the SPY? And I did bring a chart on that. If they outperform the SPY, what does that mean? And this might give an indication of what the Fed is going to do, because if the Fed is looking at these long bonds and yields relaxing on the back end while the yield curve so inverted, it could mean that they would at least be very, very non-aggressive going forward in terms of the yields, raising them, because they're going to be starting to see signs of this recession. To what level is what they're kind of hoping for, right, to fight inflation, but it could all come back and haunt them, because it could turn out to be more of that stagflation that we have feared for quite some time now. Did I answer all the parts of your question?
I think you answered it and more. So a great answer. I want to touch on something that you brought up here, which is the inversion of the yield curve right now, something that anyone can take a look at. 2's10 spread right now upside down, 90 basis points, minus 88 bips on my screen, coming in a little bit today. This is obviously something that that's available publicly for anyone with a web browser. But I want to also talk about something that the pros use, which you probably don't have access to unless you have a Bloomberg terminal, because this is the way pros think about interest rates. This is an important point, I think. 0726, this is the next Fed meeting. Right now, the percentage hike cut is priced at 88.8%, implied rate increase of 0.222, meaning a very high probability we're going to get a 25 basis point hike at the next meeting. Right now, the implied rate on that is about 5.3%, 5.298. Right now, we're at 500 to 525 bips, effective rate 5.08. You add that together with the 5.22, that the 0.22 implied rate increase, and that's where you get this number from. This is obviously something that's been priced in based on the day to day. I think this is pretty much flat day over day in terms of the pricing on that, but very clear, just about everyone in these markets expecting a 25 basis point hike at the next meeting in July 7/26.
Well, I certainly would be probably leaning towards the fact that they will, for the very simple reason is you can look at all the number crunching that you just did, but just listen to Powell. And basically, Powell said that he was going to raise, again, another 0.25%. Of course, he always capitulates with data plots and economic statistics and all of that. But the jobs report and the PCE, which hasn't come out yet, are two of the biggest places that Powell will look. And both of those will indicate, I think, a rationale for him to do exactly what he said he's going to do. So if we believe him, he's going to raise.
Mish, I love the way you frame that, and thank you for calling me out. I love the numbers. Sometimes I geek out on it, but the point is such an important one that you've just raised, which is ultimately this question of, does the data come first or does the rationale come first? Do you kind of come up with the way that you want to do this, and then markets move in relationship to that? If the Fed chair wants to move rates, that's what the Fed chair is going to do.
And one of the things we can say in favor of Powell is he's been kind of transparent about what he's going to do. We knew he was going to pause last month because he basically said, we're considering pausing. Once he says something like that, take him at face value. This time he has said something different. So I would say that he'll probably raise. What kind of impact that's going to have? Well, there's going to be one factor along with a few other factors, and that's what makes this market forever interesting and always means that as a trader, you have to be adaptable. Look what's happening in the face of that, the dollar, right? The dollar went down really hard in the last couple of days, and that obviously has given a boost to some equities because of dollar-denominated instruments that need to actually have a softer dollar, of course. But at the same token, when yields go up, generally so does the dollar, and with the dollar falling like that, one has to wonder what's going on. Where's that relationship breaking apart? And what does it mean if the dollar continues to go south from here? And so that's also another area to be focusing on. And then, of course, earnings, which is also going to be a very, very interesting. Again, backwards looking, but nonetheless, it's always about what they say going forward. And will they have experienced more layoffs? Will higher interest rates, especially if they raise, as we consider they probably will, affect their bottom line going forward? What about inflation? Is it's taking a break now, but still they're paying outrageous prices for things? There's so many interesting things to look at. That's why sometimes it's so much fun, Ash, to talk about all of this and conjecture what we think could happen based on this number versus that number. But I always find so much comfort in the chart. So.
Yeah, very well said. Listen, talking about all of this, I want to take a look at something that's extremely relevant to exactly this point. This is a deep dive conversation. Is the business cycle rebounding? Christophe Olare with Andreas Steno Larsen. Let's take a look at this because it addresses some of those very points that we were just talking about.
I think that they're going to keep on repeating that the same communication for longer. Again, the last paragraph of the RBNZ today was very crystal clear. First of all, they say we are confident that now the level of rates will be enough to bring back inflation within the 1% to 3% target range. Confident is one of the first time they're using that term, that some decent progress is made. But they say as well that we're going to stay there for an extended period of time. And I think that this is the second step. Okay, we pause, but for now, pause doesn't mean pivoting. Pause means we stay in restrictive territory for, I don't think they're going to stay there for 2024, to be honest, but I think that their time frame is at least communicating until no cuts in 2023 for sure.
All right, I love that clip because Christophe Olare does not mince words in it. No econo-speak there. He ends at the end by saying, no cuts in 2023 for sure. Obviously, this is about this weird market we find ourselves in where the expectation is that the Fed is going to hike and then have to cut as the U.S. enters recession. Really powerful statement there from Christophe Olare. Mish, what are your thoughts?
Well, I was actually really happy to hear him speak because it was in line kind of with what I'm been thinking. And it's always great for me when I'm putting thoughts together in my head and then someone so eloquently articulates it. And that's basically what he did. So, just to recap, I mean, he said, right, there's no cuts happening in 2023. However, he also felt that there would be a pause. And here we're just talking about now the raise for July, but that may be the last raise. And I believe last time you and I spoke, Ash, we talked a lot about historically June, July often becomes the peak in terms of the interest rates. So that would support that. And then he said they'll be higher for longer, right? So that definitely means that he's thinking the way we're thinking, which is the Fed will have to keep the pedal on because of inflation, essentially. Inflation is going to continue to drive Fed policy. And then he said, finally, maybe in 2024, the cut, which also supports what we just talked about in the beginning, which is the fact that at some point, the inflation or even the stagflation narrative can become more recessionary if the Fed becomes too aggressive in terms of the raising of the rates. And we start to see some real issues with labor and, of course, even with just industrial output.
Bishop, let's talk a little bit about, with that framework, with that thesis you have, how that trickles down, how that pushes out into various sectors. Obviously, we were talking earlier, tech is just red hot on the year. I'm looking at XLK, the Technology Select Sector Spider Fund, up about 41% year to date. Talk a little bit about the dynamics of how you see different sectors being impacted by your longer range thesis?
Well, the whole idea of the tech space as its own living and breathing animal, I think we still don't really understand fully what the impact of AI is going to be. And again, a lot of speculation on what it does to the labor market, but yet what it also does in terms of efficiency, and how much reliance there's going to be just in terms of being able to produce things much faster. I mean,
Right.
on a personal level, I know that it definitely helps me, because when I go and ask a question now to ChatGPT about something, I get an answer so fast it's blinding to me how fast the answer is. And that's just on an individual basis. Obviously, it's being used all over. And of
Right.
course, we know that during COVID, the area that went up as we were during COVID was tech, because it's something that people can use at home. And I think that's also another big factor. And, we can get into the whole sociological aspects of tech and how we've become more and more of a society that depends on the virtual experience
Right.
more than the actual experience. And of course, that's why Zuckerberg and Meta stock has gone ballistic on top of the Threads thing with social media, but that's not a conversation we need to have right now. So to get back to your question on how does not only the fact that the interest rates could possibly go up, but it may not necessarily control the type of inflation that we can see coming, because demand is much stronger than anybody anticipated. And the consumer is much stronger than what anybody anticipated at this point. I think what could start to happen is that people will get a little bit more panicked and pull back in some of that discretionary spending even more, although we haven't seen it lately. I think that that could be a factor, but I also think I'd rather than take a more negative bent to look at things in terms of opportunity, because that's obviously what we're all about, is trading opportunity. I think it really gives a lot of opportunity in terms of some of the commodities that have fallen hard, which is the nature of commodities, and other commodities that haven't fallen that hard, like gold. People thought gold was going to really drop and dive, and instead it just went from 1900 in essence back up to around 1965. And that was just in the last few days. So if the economy is recovering so greatly and inflation has been beat and the Fed's going to raise one more time, and that might drive us eventually into a recession, gold is certainly having something else to say about it.
Well, that's such an interesting point. And, it is kind of, you never know, obviously, what's inside the collective minds of traders, but it does seem as though all the points that you made earlier about the social, cultural, sociological changes that we're going to see with the work from home, AI, what's going to happen in the labor market, gold may look like a real risk-off hedge in that context.
Exactly. And everything is, great point, Ash, because everything right now, if you look at the ratios between the things that we like to look at, like the junk bonds versus the long bonds, one of my favorite, or gold versus SPY, or long bonds versus SPY. They've been in a risk-on situation to this point. As the market is rallying, though, we're starting to see some shifts. And I know I brought some of those charts in on the relationships. HYG, which I like to use for the junk bonds, is still well outperforming the TLTs. That's risk on, right? You want people to be interested in buying high yield debt, but it's turning lower, as you can see in that middle chart there that I pointed out. It's actually in the relationship turning lower. So that's something to watch out for, but that's still risk on. But if you look at the TLT versus the SPY, let's put that chart up, Brian. What you can see here is that, again, the TLTs have been underperforming the SPY, but you want to keep your eyes on that. And I don't know if I brought the gold versus the SPY. Can you put up the gold chart? Because this is the one concern that we're seeing.
Let's see. I think they're looking for that right now.
Okay. So look
There
at
it
that.
is.
Ash, look at that. So if you look at the middle chart, right, that is our real motion. That is our triple play leadership indicator. And look what's happening. The blue line would be the ratio against the red line against the SPY. And look what gold is doing. It's starting to go on par with the SPY. And if gold starts to outperform here, then I would say that would be a lead indicator to maybe some risk off happening as we continue into the summer, which of course would also be in line with the 6-month calendar range reset and a possible rate hike that people don't really want to see, which would then lead to maybe some more weakness in the labor market, et cetera, et cetera, et cetera.
Mish, this is an important chart, and I know that a lot of our listeners are listening to this as a podcast and they're not able to see it. Walk us through what you're seeing in that chart and why it's significant for people who are listening on audio only.
Okay, well, first of all, the top of the chart there, for those who can see it, is the, this is GLD. So let's make that clear. First of all, this is not gold futures. So that would be 1960, 1963, something like that is where it closed today. And in this chart, and thank you for making it a little bigger for me, for us hard of seeing here.
Me too. Very helpful.
I put my glasses on so I can lead into it a little bit. What's so interesting about this GLD, and it's a pretty good ETF to track the gold futures market, by the way. It's not filled with other things like some of the other ETFs that track commodities. But in this particular one, look what happened today. So right now, we just had tremendous support at around that 175, 176 level, and we're getting closer now to the 50-day moving average, which comes in right around 182. So that's the price, and that would probably correspond with the difference between gold holding 1930, which it just cleared, which it has to continue to hold, and getting through, let's say, 1980 and then 2000, which we have not seen now in quite some time, in a few months. So that would be the price. So you want to watch for the 1980 to 2000 in cash, and you want to watch the GLD right now to take out 182. If that happens, regardless of what the SPY does, unless it really has a big gap up and keeps going, we're going to start talking risk off. That's what my leadership indicator. The bottom one is momentum, real motion. So basically what that does is that measures momentum, and we look for divergence. And this still shows there's a little bit of a negative divergence between momentum and price, in that the dots are not quite over the 50-day moving average yet, while the price is testing it. So we're not there yet. So I'm not going to say sell everything and buy gold and, unequivocally, but I am going to say probably makes sense to watch what happens over the next couple of days as we digest what happened today. And, sometimes it's right, buy into the news and then sell the actual news, and watch the gold market, and especially the ratio against the SPY, to see if that isn't our first indicator that things are about to shift a little bit in terms of risk.
I'm so glad we were able to unpack that before the first half of the show ended. I think very helpful explanation there, and great that people who are listening to this on audio, and many of our listeners are, got to that explanation as well as the visuals on the chart for those who are watching. That about wraps up the first half of the daily briefing. We're going to continue this conversation, of course, on the Real Vision platform. If you're watching on YouTube, I've got some great news for you. First, smash the like button. But if you're not a member, click the link in the description or scan the QR code on the screen and join this incredible community so you can continue following this conversation. We're about to do some Q&A, questions and answers, here on the back app. Questions are coming in fast and thick right now from our regular viewers and from a lot of other folks. So please stay tuned for that. Okay, here we are after the jump on the Real Vision platform. Lots of questions coming in. Mish, do you mind if we just jump into these right now?
I hope I can answer them.
Okay, first question comes to us from David Kelly on the Real Vision platform. Afternoon, Mitch. Mish, do you think the dollar will rise with inflation next year, and will that hurt commodities? Great question.
Well, the dollar right now just broke a very key number, and I think I brought that chart too. It's actually the only black backdrop chart. Right, there you go. The reason why I had to put it into the TradeStation format and not in the stock charts format is I couldn't get this monthly indicator with these two key moving averages. So, I've been big about the 23-month, right? And that's why I hope one of the questions are about the Russells. If not, I'm just going to have to talk about it because I just have to. So
I was looking at Russell earlier today, actually.
Right. You have to watch the Russells. But anyway, let's talk about the dollar here for a second. So for the first time, really, since 2021, today, or in the last couple of days, the dollar broke down under the 23-month, which means the entire period that we've seen of expansion in the U.S. dollar is now stopped. Now, does that mean we can't see little pops and rallies from here? Yeah, absolutely. And it also means, and this is very important, David, is that it also means that we have to look at this at the end of the month, right? Because this is a monthly moving average. Intra-month doesn't really necessarily mean everything. It's really what's going to happen at the end of July. If this closes underneath the 23-month, then I definitely think we're going to see a further drop in the dollar, maybe testing that 80-month moving average is what you see there in the green line, right? That's the 80 months. So that's something to look at. And so to answer your question, BRICS, which was the big conversation, by the way, just took a big hit, right? Because India said they're not going to join BRICS. But nonetheless, there has been other issues with the dollar, clearly. And so it seems to me that if I had to guess, I don't think the dollar will fully collapse like necessarily under 98, but you got to watch the relationships, the pairs. Watch the dollar against the yen and watch the dollar against the euro, because both charts look very different and they may give a little bit more information. So the euro right now is well outperforming the dollar, and that broke down for the dollar in the last couple of days. Whereas the yen failed, the dollar yen failed 145, which was the big number that so many currency traders were looking at. But in the 23-month moving average, it's very far from fully breaking down. So I guess the short answer to my very long answer right there is I would think that in order for us to see a really prolonged, hurtful inflation, we'd have to see that dollar continue south. And if it actually bounces for here for any reason, whatever that might be, then I would certainly say that it could hurt certain commodities. But remember, gold, I don't think gold really cares about what the dollar is doing right now. Gold is definitely dancing and to its own drum.
Yeah, that's so well said. I think that's exactly right. It just seems to be looking at a different context for all of this. Boy, wouldn't it be fun to get an India expert on with you and me to talk about this BRICS thing? I mean, it's just so fascinating that the Indians essentially are saying, hey, we're doing pretty well in terms of GDP. We wish you luck if you want to start this settlement system, but we're okay. Thank you.
Yeah. And they're the largest growing economy right now, too. I think I saw projections that they may take over everyone by 2075. Now, of course, I've always find, what happens in 50 years from now, I won't be alive. But still, it's interesting that the projection for India is just so tremendous.
We'll be on a beach in Florida, like sipping Mai Tais.
Dribbling Mai Tais for me more like it.
If that's what it comes to, I'll take it. Talking about BRICS and Asia, here's a question from Sunil Lula on the Real Vision platform. Do you see disappointing growth from China? And then the next question, impact on oil. Great question.
I do Twitter Spaces once in a while, and everybody wants to be a China expert, and I certainly don't claim to be any China expert, but it is such a great question. Because there's been stories lately that China's in big trouble, and they're using the examples of the fact that they are supporting the housing market there by basically giving the money to be able to pay for the mortgages. But yet at the same time, I always say my biggest support of China, and a lot of the information I get from China, by the way, is from a friend of mine who is Chinese, who lives here in Santa Fe, but speaks to her family in China, who lived through the Cultural Revolution and has, I think, a really good perspective coming from a non-propaganda point of view. Just really what she boots on the ground in China, so to speak, from her extended family there. Yeah. And what she says is this. She says, number one is the goal of China, and has basically met the goal, is to eradicate poverty. They basically have succeeded in that goal. The fact that Xi can stimulate the economy any way he needs to do so without the confines of what we have here in the United States certainly speaks volumes to how far they're willing to go to make sure that nobody goes bankrupt, and that includes the housing industry. So that's number one. I think that China's biggest concern should be a global concern that we all have, which is supplying enough raw materials, particularly food, to feed the growing demand of that country and all countries for that matter. Just to make a little aside here, Canada came out today and said they think inflation is going to stick around until 2025, which also basically supports Christoph and my point of view. Mm. And why? Because demand is much higher than they anticipated, and the housing market is much stronger than they anticipated. So getting back to China, the fact is that if they have a lower inflation rate because of the housing, but yet they have the global demand and issues about food, that could trip them up. But they're correcting a lot of the bad policies that they made, particularly in the tech space, where they so overregulated them that it actually choked the economy a little bit, and they're loosening up on that. So my long-term view of China is always very positive. They're a meritocracy. I believe that, yes, of course, they can make mistakes. Clearly, what's going on between the U.S. and China is a factor in terms of the trade sanctions, and I know they would love for that to be released and made better so that we can trade more freely with China. That would help. I think probably maybe even both countries in a way. But still, the point is that China still, at this point right now, I don't see it has much downside. I think it's already made its major correction. And now at this point, I would be actually looking more for opportunities there.
You know, it's so interesting. You talk about essentially the ability of the party in China to essentially stimulate from here until kingdom come. You have to wonder, I guess, is that like a double-edged sword? I want to give the Jeff Goldblum speech from Jurassic Park about the power and what that could potentially mean. I mean, it's just got to be so easy to say, well, that's okay. We can just dial this up a little bit. Well, that's fine. We can just dial that down a little bit. And then you wind up 5, 10, 20 years with markets that are effectively not really markets, right? They're just essentially structured from the command side, and you don't really have price discovery, you don't really have supply and demand, and things just get horribly out of whack. I guess that's a risk. By the way, while we're in that neighborhood, Mish, I got to ask you about Vietnam, talking about East Asia. What are your thoughts there? This is a trade that's worked out very well for you.
I will answer that in 1 second. I just want to say one other, I think one of the biggest concerns for China is that there are just not enough young people because of they're still feeling the impacts of the one-child policy. And if you don't have a younger workforce, that could be a factor until that all works out and the birth rate starts to go back up. And I think that's being felt all over the world, but particularly in China because of that policy. So I just wanted to add that. That might be the biggest concern they have. But I think they'll get over that speed bump in essence. Now, let's talk about Vietnam. So the last time I was with you, we talked about that as the sleeper trade, and I didn't supply a chart of Vietnam, but I have it in my head. So I don't remember exactly where it was trading when we talked, because I remember people asking me, well, where would you buy it? And I think I had said, well, if it dips down to around 12, and I don't know if it ever did. But essentially right now, it has broken out of a big base. From a fundamental standpoint, Vietnam, the only negative thing I have read about Vietnam, and I know that this is going to be funny to you, Ash, and Brian will probably chuckle in the background, is they're actually banning the Barbie movie. And they're banning the Barbie movie because there was a map drawn in the film of Southeast Asia that still showed that China had control of some of the areas that Vietnam has control of. Interesting, right? Just goes to show you how sensitive governments can be. But anyway, getting back. But they still have tremendous amount of manufacturing capabilities. They still have a very strong labor force that works for cheaper wages. And there is a country that is being turned to by many other countries right now for the manufacturing. And Vietnam itself is just buzzing away. I mean, it's a very vibrant, industrious country. Yeah. So if you consider that, if you look at a chart, how China's manufacturing in terms of exports have come down and Vietnam's have gone up, I'm looking at the chart right now. It's trading at around 1370. It's got some resistance coming in at around 15. We've been long since, oh my God, I think around 1150. So we're going to probably look to start taking profits somewhere over 14, between 14 and 15. So that's not saying that I don't think it can go to 20, but any kind of good pullback in there, anywhere close now back down to around 13, I think would be another buy opportunity.
Mish, I have to tell you, after our last conversation when you were talking about Vietnam, I went on YouTube that night and did a couple of tours of Ho Chi Minh City. It's just extraordinary. I was just blown away by how, by the way, how favorably it compares to New York City in terms of cleanliness, modernity, bright, clean, beautiful city, high rises, and then the old side of town, quaint, beautiful, lovely gardens. I mean, just absolutely gorgeous place.
Yeah, they've definitely come far from the Vietnam War way back in the 60s.
Yeah, go to YouTube and check out Tour of Ho Chi Minh City if just to get a little bit of a context on it, just the extraordinary amount of building and development that they've done there. It's really an incredible story. Okay, one more question. This one from Paul English, a Real Vision viewer. This is clearly someone who spends a lot of time thinking about the history of markets. The yield curve has only been this inverted 3 times before, 1929, 1973, and 1979, and those didn't end well. Why will this time be any different? Great question, Paul English.
It's a great question. I don't necessarily think it's going to be any different. That's the thing is, first of all, in terms of the balance sheet of the Fed, we haven't mentioned the balance sheet at all, but and I think the banking earnings will shed some more light on this. But the balance sheet had actually continued to grow again to actually bail out the regional banks when we had those issues. And some people out there believe that those issues just have not completely gone away. And of course, being tied to commercial real estate, as the regional banks are, I certainly see even in our local areas, commercial real estate is really still suffering. So now the Fed has started to actually reduce the balance sheet again, but still not by any great measures compared to how aggressive hawkish they sound with interest rates. So that's one of the reasons, and I'm mentioning that because that's one of the reasons why this may not end so well, because they're trying to spread their tentacles too far. They're trying to control an inflation that may not be controllable because you can't control Mother Nature, you can't control geopolitics, a la Jeffrey Sachs, and you certainly can't control what happens to social unrest when people are stretched to pay higher interest rates and higher food prices and higher energy prices. At some point, people say enough is enough. So that's something to consider in all of this equation. So going back to 79, we've talked a lot about the 70s, and we have a ripe situation to have a repeat, only worse, because we have a global situation, not just a domestic U.S. situation in terms of everything I just mentioned, inflation, social unrest, geopolitics. So yeah, what could stop it? I don't know. Right now, things certainly seem to be going in that direction. And I always like to say, if you put your ear to the ground, you still feel a lot of rumblings under there. So I'm not necessarily sure we've seen the worst of it yet.
Interesting. Something completely different. Here's one from Trillion X Macro from the Real Vision platform. Mish, do you think cannabis stocks are ready for a YOLO rebound as regulation in the U.S. and Germany seem more favorable?
I am so happy you guys asked me that question because I wrote a daily a couple of weeks ago on cannabis. Is it all so low that it's ready to go high? Double entendre, ha, ha, ha. And actually, we bought some MSOS. There's a couple of things that I feel like, could it go any cheaper at this point? And so $5 is like my baseline. It can't break. And it traded as high as $6.50 recently, and I think today it went down a little bit. Mostly, I think, just from lack of interest, with so many other things more interesting to put money in. But to answer your question, I actually think there's a good chance that it has bottomed. I think that with all of the medical advances we've heard recently, there's been certain ties, clearly, even though it's been talked about before, of glaucoma and cannabis, how it helps glaucoma, depression, anxiety. Of course, we already know that. Obviously, there's the whole idea of microdosing going on at this point, too. The point is at what point does the federal government decide to go ahead and allow interbank for cannabis? And I think it's just a matter of time. I don't think it's not going to happen. I think it's just a matter of when.
Yeah. Next, I'll give you an anecdotal story. Here in New York City, the aroma of cannabis is ubiquitous this summer, as it has been for a long time. What's fascinating about it to me is that, on my block, I have 2 unlicensed cannabis stores. And I believe there are something like 3 or 4 licensed recreational cannabis stores in Manhattan right now. This is actually really kind of quite interesting because it suggests that there's all this demand in this kind of gray market that probably hasn't yet begun to trickle in to the regulated stream, which means we're not seeing those showing up on balance sheets of publicly traded companies, most likely. So it's an interesting point.
And it is. And, I know they're doing some crackdowns on the illegal cannabis stores. So that could be a first glimpse into the fact that the federal government decides to do more in terms of regulation, in which case would be obviously freeing up the abilities for them to do banking across state lines. So we'll see.
Indeed. It appears as though Raoul Pal has joined us just in time for the cannabis conversation. Was that intentional, Raoul?
Hey, Mish, how are you?
I'm good, Raoul. How are you?
I'm fabulous. Hey, Ash, good to see you.
Hey, Raoul, good to see you, man.
I live in the Caribbean. I love the cannabis conversation. Jamaica's just next door, right?
Exactly.
Mish and I have been having a very deep, detailed conversation about CPI. You just jump in and it goes to cannabis. I don't know how that happens.
What's so funny, Raoul, is I expected the normal questions I get about silver and aluminum and nickel, and grains, and all the different commodities that I always talk about, but instead it went right to cannabis. So obviously it's on a lot of people's minds.
It's actually been quite a tough market, cannabis, isn't it? Cannabis stocks have not done well.
No, it's done horribly, but that could be over.
Yeah, the question was about the rebound. So, Mish, we've had this conversation. We've been going for almost an hour here, covered a tremendous amount of ground. Final thoughts, key takeaways that you'd like to leave our audience with?
Well, I really think that one should pay attention now to what happens, as I mentioned in the very beginning. The key areas would be the relationships that we talked about. Watch those long bonds through the TLTs, how they perform against the SPY. Right now, they're still underperforming, risk on. But also watch the gold versus the SPY because that could be signaling risk off. And then also the other great relationship to watch is the junk bonds versus the long bonds. And as junk bonds continue to outperform, that's still a good sign. Basically, what that suggests is regardless of what the Fed does, that we still have gotten through the obstacles and the headwinds of what could have happened and what most people feared would happen and did not. If that flips, though, then I would start to get way more cautious and a lot more nervous and then look at the opportunities again in particularly precious metals, but some of the other commodities along with that.
Well said. Mish Schneider, always a great conversation, always a pleasure, always great questions. Thank you so much for joining us.
Thank you so much, Ash. It was a pleasure to be here.
Nice to see you, Mish.
Nice to see you, Al.